legitimate investment confirmed by our valuation. But before diving into detail, let's see PTG at a glance. PTG ranked second in Thai oil retailing under PT brand and further strengthened ecosystem through non-oil ventures and biodiesel upstream joint venture. It mainly operate through company-owned, company-operated station with 12.6 million Metcard member, ensuring full controls and in-station traffic. The majority of station is in provincial area as it aims to target Thai rural, this translates into diesel to total volume sold of 72%. Looking into oil retailing industry, see that the market is highly concentrated, as 23% of stations generate 84% of total volume sold. This is while PTG, the fastest growing player, has strived against the tide for the past 5 years, shown by 1.4 and 1.8 times surge in its market share by volume and station respectively. The success was achieved through small town expansion, station conversion, and better brand recognition. So ladies and gentlemen, PTG's strong fundamental and past success are only small part. Why we call it back, the bigger parts lies in the future.
So let's start with our first reason, where we believe that PTG oil volume growth will continue to be favorable. PTG is expanding into more robust demand areas like Bangkok and Eastern region, where oil consumption, growth, and volume per station are more favorable. We see that this move is highly feasible as station concentration in key region is still low, and PTG yearly expansion plan requires only 1% of the non-branded station to be converted. Also, PTG could expand twice as much with the same amount of capex while having faster time to market and additional depth room for expansion. Looking deeper, while other players are competing in the main road, PTG aims to be nearer to the customer and beat the market by tapping into residential area with super small format and competing in the sub-road with more amenities through max count. We believe that this is the winning strategy enabled by its cohort focus model, which allows for localization and 2 times higher cashback per liter through PT Max Card. With this, PTG footprint will reach 2.4 thousand stations by 2025, and as they have better brand recognition, PTG SSSG will beat the industry by 1.3% with an oil volume CAGR of over 6%. And to top off the promising volume growth, PTG marketing margin will also be stable at a high normal level. With a big change in marketing margin affecting PTG EPS by 3%, we analyze that the currently high marketing margin is here to stay for 2 factors. First, stabilizing crude oil price from OPEC monthly meeting from the norm of twice a year to adjust production level. Second, Thai baht, a factor 7 times more sensitive to marketing margin, is strengthening from attractive real policy rate and Thailand account surplus from the recovery of export and tourism sector. With this, our regression analysis also confirmed a marketing margin range of 1.8 to 2.2 Thai baht per liter, signifying a high normal level compared to pre-2017. So with all of this, we expect PTG to be the main beneficiary as they don't need to share marketing margin with the dealers from its cohort focus model.
Not only oil side that look promising, but also non-oil and joint venture business. We see that leading players enhance in-station traffic by adding cafe in the station. This is an opportunity for PTG since the market is growing and currently Pantai covers only 12% of total PTG station. Moreover, Pantai could leverage on 12.6 million members of PT Max Card to compete in the market. As a result, we expect Pantai to break even in the next 3 years, which will help PTG to become more resilient to marketing margin fluctuation. Second, synergy between biodiesel refinery and PTG will be realized. This is ensured by a secure distribution channel from PTG and support from government to encourage biodiesel usage. We analyze that with excessive demand from PTG, PPP will run at full capacity throughout the next 5 years, despite the capacity expansion. And in return, PTG will enjoy an implicit cost saving of 0.83 Thai baht per liter by having PPP in hand. As a result, PTG will cover the traffic creation, better brand recognition, and synergy from PPP, together with a more stable ROE at around 20% and improving net profit margin up to 2.1% by 2025 forecast this year. And lastly, PTG is a legitimate investment, confirmed by our valuation. PTG stock price dropped by 50% and now is still below the pre-COVID level, while net profit is expected to be at all-time high as a result of resilient demand, station expansion, and effective cost control. However, PTG is now traded around -1 SD in both PE and EV/EBITDA band, which is only 16 and 18% of the time in the past 5 years. So ladies and gentlemen, our rare discount has now returned.
Our sum of the part valuation suggests a target price of 21.04 Thai baht, incorporating different financial performance and risk profile. We break it down into 3 units of core, food and beverage, and Valuation refinery. We use 2-stage SFF model to all units, SF&B, where we use 3-stage to allow Hantai to reach a mature phase by 2030. First, core units of 18 baht is mainly driven by 3 main drivers: an oil volume growth of 6.7% CAGR due to growing volume per station and station expansions, a stable marketing margins of around 1.9 baht, and non-oil sales growth of 19.7% CAGR, mainly driven by expansions in LPG and other bags. Second, F&B of 1 baht is mainly driven by 19.6% CAGR from Pantai sales over the forecasted period, due to the store expansions and growing sales per store up to 3.2 million baht by 2030. Lastly, a 40% ownership in PPP gives a values of 1.8 baht to our target price, with an expected profit of over 1 billion baht in the future. This is driven by the full utilization rate, double capacity, and favorable margins at 3.8 baht per liter. To confirm our valuations, we benchmark its PE and PEG ratio with its peers. Both indicates that PTG is undervalued and it's just the right time to buy.
And now that we have filled our tank with our rationale filled, let's do a final check on risk and ESG analysis before getting on that highway of prosperity. We conduct a risk prioritization where we see that the emergence of EV and marketing margins fluctuation are the 2 key risks towards our investment. Starting off with EV risk, we deplete PTG oil cash flow to 0 to see the impact on our target price, given that the company didn't do anything. An extreme case with aggressive adoption would incur a downside of 4.9 baht, resulting in a whole recommendation. However, this is highly unlikely, as PTG already has planned to install EV charger and the government support only extend to EEP case, a scenario with a downside of 2.1 baht. Still a buy recommendation. Next, our Monte Carlo model based on marketing margin with 10,000 observation and 5 back scenario suggests a 67% buy probability. And even if PTG marketing margin were to fall into its 5-year worst of 1.8 Thai baht per liter from this year onwards, it would still result in a hole. However, we don't think that this is the case, as given the current Thai baht strength, the Brent oil price will need to be in the pre-shale oil boom period, which hasn't happened for the past 7 years. Our analysis also extends to E, S, and G, where PTG earned a B+ rating from Refinitiv. Environmentally, the company has been a supporter of using clean energy by implementing biodiesel use in logistics and solar rooftop installation. Socially, PTG emphasized on both society and workforce development with total training hours provided of 100,000 hours. And finally, for governance, where PTG earned an excellent rating from Thai IOD, highlighting a transparent and rewarded management. With this, PTG will not only be a growing company, but will be a company with sustainability. And even with ESG affecting investor risk appetite and company future performance, our sensitivity model still suggests a buy in most of the scenario. So ladies and gentlemen, today we place a buy recommendation on PTG under our rationale of field. Thus, before this stock set apart on a highway departure, we would like to invite you to take the ride and let's view the upside together. Thank you.
Now it's time for Q&A session.
Good job. Can I ask you about your valuation? Can you show a slide of your valuation? And in particular, I'm looking at your weighted average cost of capital, which is a pretty high number. Let's say we've seen some other numbers today, but your number is about roughly 10%. Please explain that and help us understand how you've come up with the variables for this.
Okay. Okay. So So to clarify that, we use a 5-year weekly beta of PTG instead of the peers of millions of peers. So the reason is that we believe that given a unique characteristic of PTG and unique expansion model, which is quite unknown in terms of in oil retail industry, so the beta should be higher, and that's given back that higher to compared to other people.
I have a question about your Thai baht view and crude oil. What makes your assumption or view more accurate than the market?
So we have done a regression analysis with the R square of over nearly 70%. In this case, our Thai baht, to be able to derive that marketing margin, we are assuming a constant Thai baht of around 30 Thai baht per USD, and we take into account the fact that crude oil price is gonna go up, and still our recommendation will still be valid at a buy. That's
Sorry,
all.
I mean, why do you think you're more accurate than what the market is seeing?
If I'm getting that correctly in terms of Thai baht only.
Okay.
To break down this question, the Thai baht would affect marketing margin, which in turn could affect our valuation a lot. In this case, we have sensitized the Thai baht given the current crude oil price, and to change our big picture recommendation, Thai baht would need to be at nearly 34 Thai baht per US dollar, which is again very highly unlikely because this case last happened 4 years ago. Thank you.
Touch a bit on the ESG. What made them deserve the high score of the CG rating?
So the higher score from corporate governance actually come from the fact that PTG as a company has a full transparency disclosure, as well as if we look into their board of director, we can see that 60% of the board of director has been with the company for a long time. And also regarding the trading activity wise, we looked into it in the past and didn't see any abnormal trading activity.
Okay, thank you.
I actually have 2 questions. The first one is about the oil retail business. So you mentioned that going forward, they're going to expand. Well, they start out in provincial area. Now they're going to expand into Bangkok and vicinity, eastern area, eastern provincial area. These are rich, relatively richer, higher GDP per capita, and there's a lot of competitors. Well established, they've been here way before you. Why do you think you can outcompete this guy? That's
Sure.
the first question.
So to answer your first concern, with PTG strategy of placing their station nearer to the customer, especially in Bangkok and vicinity, we believe that the traffic creation would be higher, as PTG aims to be the first and last place for the customer to visit. For other region, PTG aims to be at the sub-road, which means that competition could be lower. However, we understand the fact that in oil retailing industry is a more undifferentiated product, thus price play a key role here. That's why we analyze that PTG, through its PT Max Card membership, can provide 2 times higher cashback per liters, and this is because they have the company-owned, company-operate model, where other players are focusing on franchising, which means that they can provide higher cashback per liters in this case. So we have an analysis on other people membership card as well in this case.
Okay, so when they start out in provincial area, their strategy is to convert the mom and pop oil stations, right? So they don't have, it's not a greenfield. They don't have to start all over from the scratch, right? But that is not possible in Bangkok, right? You're not having any mom and pop gas station, that doesn't exist anymore. So it's going to be a greenfield. So you have to invest a lot more compared to the provincial oil station. So do you think that would affect your return on invested capital going forward?
Okay, I understand that, but actually, in terms of the station in Bangkok, there's still the non-branded to be converted. And also, I understand you about the capex, but we already incorporate the increase in CapEx already, and our valuation is still a buy recommendation at 21.04.
Can you show your free cash flow forecast? What I just noticed on your CapEx chart is that your CapEx is falling in the final years, right? And let's just see here. So also your changes in working capital there are positive when usually it's negative, but I think in this case it is a negative cash conversion cycle, right? Okay. My question is, I'm trying to understand how you get to a target price of 21 roughly with such a high discount rate, whereas prior teams we saw at roughly the same amount with a much lower. So can you just explain about free cash flow a little bit so that we understand where this strength is coming from?
Okay, so in this case, we expanding PTG footprint around 80 to 100 stations per year, and also we assume the growth rate around 4% throughout the forecast period. And also, in terms of the CapEx that you're wondering, is that in terms of next 2 years, the expansion will be more selectively expand.
So just to a quick add-on on that, we have analyzed that in the future, PTG will rely more on their oil growth, will rely more on higher sales per station, in which I've done analysis here. Because in the past, they have been expanding aggressively, thus their growth comes mainly from station expansion. However, in our model, we are suggesting a station expansion of around 50 to around 100 stations per year with at SSG at the same rate for that of the market. So in the future, they will be relying more on sales from higher volume sales per station.
Okay, so in order for us to feel comfortable with your valuation, is that the EBITDA is going to be rising and the CapEx is going to be falling, or let's say less than what it was in the past, which gives us a higher free cash flow in the future years. I would say that's a risk in my perspective. But the next question I have is, why is, we've asked before to other teams about the idea of leasing the facilities versus operating the convenience and all that, and then you're showing me that Pantai doesn't make profit or break even until 2024. Why are they wasting their time in this business? Why not just lease it out to operators that could be much, much more efficient?
Okay, so to clarify that, if PTG doing Pantai as their own, they could give back a cash back to customer 2 times more than other players does. And also, this will attract more customer coming into Pantai Coffee, given that Thai norms of living in free giveaway or a discount. And also, the reason behind the break even is that currently SG&A per store is around 1.2 million. And in order to cover that cost, Pantai should sell around 100 per store per day to cover that cost. And we expect that to be in 2024 as a result of the station expansion and growing Thai norms of buying station coffee.
A question on your valuations. You mentioned PE and EV EBITDA being one standard deviation below. Where is your view different from the market then, to explain this difference?
Okay, so our view is that PTG is now relatively undervalued. So we have to go through the domestic peers and also international peers. All of them are increasing at around 30%. But currently, PTG is almost the most laggard players in this industry. So our view is different because the net profit is already at all-time high. So this would be a catalyst to PTG stock price to skyrocket this Monday morning as well.
Monday morning, you mean? Alright, I have a question about your ROE slide. So there's a big jump in the ROE from 2018, from 11.4% to 23% in 2019. What was the cause of that?
Okay, this is mainly due to we can increase the net profit margin while we can using lower leverage. Yeah.
And just to add on to that, in the year 2022, PPP just expanded their capacity by 2 times, thus resulting in higher profit margin.
Right.
Time is up for Q&A session. our judge can give you the feedback.
Yeah, right, you can be off stage, right?
Yeah.
Please stay first.
Thank you for a very good presentation. You guys have good time management for the presentation, and also the good visualization on your. And other than that, be like I think how you present in terms of the valuation. I think it's a bit. A lot of data on your presentation. Sometimes you may have make it more comprehensive for the user. Thank you.
Thank you.
Good job. I think that the slides were more easy for me to understand. Like here we have just two, I think even that's hard sometimes as a judge, but also I think sometimes you show just one and then another. So I think that was good. I think your Q&A you did pretty well. You definitely stayed on point. That's the key thing, But I would say also your band charts or showing where the multiples were. I think the challenge for you and all the teams is that you need to explain why the market is wrong. And I think that's the question that we're trying to get out of you. Because everybody can see that chart shows it's down, but people are going to say, yeah, so what am I going to believe? 1 million people that are buying in the market, or you? Well, you've done a lot of work on it, so maybe you. Also on ESG, I think that you have to highlight, I think almost no team really highlighted the downside. It's all, this company's great, ESG's great, they do this, they do that. Well, that's bullshit, we know that. That's just companies, trying to tick all the boxes, but we also have to kind of understand any risks and stuff like that. As far as your presentation, I think it was good, and I like one thing in particular is that right in the beginning you explained like how or what caused the change. I think that's very important. One thing I do want to say is that when you answered a question, you slipped and you said we, as if you were answering from the company's perspective. Remember, you are the analyst on the outside analyzing the company. So those are some of my comments.
So actually, I think the presentation is good. The slide quality is good. Overall, very smooth. And just one thing, that there's one slide that really raised the questions, and I think if you get to pass into the regional round, you should definitely take it into the appendix part. Don't mention it. That is the historical PE band and EV/EBITDA band. Now you're saying to us that this thing used to trade 35 times. And now it's trading at 20 times, so it's one standard deviation below 5 years mean, right? That is just not gonna cut it, right? So you do the peer comparison, that's good. You do the DCF, sum of the part, you forecast all this business on a standalone basis, and then you combine it together. That is all great. Just take that thing out. It's going to raise the questions.
I like your time management. It's exactly 10 minutes for your presentation. On the Q&A, just it could cover all the questions we asked, or just answer the question that the judge is asking. I think we say that for most of the teams as well. That would help you immensely. Listen to the question. There's a reason behind why the judge is asking, and answer that to the judge.
Thank you, our judges, for your feedback, and thank you, Team C, for your presentation. You can stay in this room to watch another presentation.